In the meantime, South Korea is expecting to see a contraction in tax revenue for the first time in 4 years, making a reduction in the fuel tax cut likely. Our economic correspondent Shin Ha-young reports.
South Korea's tax revenue may fall short of its estimate this year. That's according to Finance Minister Choo Kyung-ho on Friday amid rising concern over tax revenue as South Korea recorded its greatest ever on-year decline earlier this year. The Ministry of Economy and Finance had already released data on the country's tax revenue for the first 2 months of 2023, which came to around 54 trillion Korean won or $41 billion, roughly $12 billion less than in the same period last year. Initially, the government forecast a total of roughly $300 billion for 2023. However, even if the government collects the same amount of tax as last year from March until the end of the year, the deficit will surpass $15 billion. And if the trend continues, tax revenue for 2023 will see an on-year decrease for the first time since 2019. And amid the growing concern, the government is reportedly reviewing a plan to gradually remove fuel tax discounts. With oil prices hitting record highs around the world last year, South Korea has been offering a temporary concession on fuel to ease the burden on drivers. From the first day of 2023, the tax cut on gasoline was reduced to 25% from 37%, while the rate for diesel has been set at 37% since last year. With that rate set to expire at the end of this month, the government must decide soon whether or not to extend the discounts. Among potential options is reducing the tax cut for diesel to the same level as gasoline or cutting the rate for both gasoline and diesel to the 15 to 20% range. Apart from fuel tax, adjusting the tax cut applied to car purchases has been also mentioned as a way to secure and stabilize tax revenue. Shin Ha-young, 아리랑뉴스.